If you invest in assets that don't beat the balance sheets, the 15% a year, you're going to be losing money every year. So it's really important that that is your hurdle rate. And when you look at that, you suddenly realize that most assets don't beat it. The S&P doesn't really beat it. Gold certainly doesn't. Real estate unlevered doesn't. Most things don't beat that debasement. So if you invest in other things, you're going to lose money. And that's a hard lesson for people to learn. Most people don't understand this simple fact, is you are getting poorer by investing in these things. And that was the big realization that got to me. It's like, oh my God, my whole macro world has been turned upside down. Because everything we thought was the investable asset became the non-investable asset. And everything we thought was non-investable because it was riskier became the asset. Because when you look at everything versus the Fed balance sheet as a simple example, there's only two assets that have gone up. And I've talked about this at length before. It's technology and it's crypto.
Raoul Pal explores the exciting investment prospects arising from the technology and cryptocurrency world. He emphasizes how technology has the power to reshape industries and generate substantial returns for investors. Pal stresses the importance of comprehending technological advancements and their impact on businesses and society. He particularly highlights the disruptive nature of innovations like artificial intelligence, blockchain, and decentralized finance, which have the potential to revolutionize traditional financial systems. When it comes to cryptocurrency, Pal expresses a positive outlook, pointing out its resilience during economic downturns and its potential as a hedge against inflation. He discusses the remarkable growth trajectory of cryptocurrencies such as Bitcoin and Ethereum, attributing their success to increasing adoption by both individual and institutional investors. Pal suggests that cryptocurrencies offer unique investment opportunities due to their limited supply, decentralized nature, and ability to serve as stores of value independent of traditional financial institutions. Furthermore, Pal argues that cryptocurrencies represent a fundamental shift in how people perceive and interact with money. He sees them as a new asset class that brings diversification benefits and the potential for significant returns in investment portfolios. Pal advises investors to allocate a portion of their capital to cryptocurrencies as part of a well-rounded investment strategy. While acknowledging the risks associated with the nascent market, he emphasizes the long-term growth prospects it holds.
The younger generation are buying passive products. Passive products drive up the value of those equities. The baby boomers are divesting themselves of active management products because that's what they grew up with. That's creating this spread between so many of the things we see today, value stocks versus growth stocks, anything in the S&P 500 or the NASDAQ versus anything outside of it. The Russell 2000 is why it always underperforms. It's because it's not part of the 401k complex of the younger people. And the old people have to sell out of this. But what we're doing is also trying to optically keep as many of these assets high. So once you understand the game, you can play the game. Most people I see on Twitter argue about why the game is happening or the unfairness of the game. And that's all correct. It's not going to save you. You're not going to unfuck yourself. Just by saying, the Federal Reserve bad, doesn't help you. What you actually need to do is figure out how to unfuck yourself. And that was the breakthrough for me with this everything code thesis and the exponential age thesis. What I started to realize is that the everything code was the understanding that they are financing all of the future. The everything code is really all about understanding that they are paying the interest on the debts by issuing more debt, and that ends up in the bank balance sheet. It was also the understanding that the world has become entirely cyclical now. The ISM cycle is perfect from one to the next. So we've got this amazing 4-year cycle. It's actually 3.5 years. And that was in fact driven by debt maturity. What we found is that after 2008 was a great reset, as we know, but it was also a debt jubilee. All of the major central banks around the world agreed to forego interest payments. That's what zero rates are. So they said, we don't need to pay interest payments because we need to rebuild our balance sheets. So they rebuilt their balance sheets by refinancing in the 3 to 5 year sector, and that's created this perfect cycle. This cycle, which is the presidential cycle, the Bitcoin halving cycle, it is the everything code cycle. That cycle drives everything. It's why I've been able to do so well in predicting where markets are going, because that cycle is the liquidity cycle, the debasement cycle. It's all one thing, and it drives assets. Once you understand that, you understand most of the game that lies ahead. Now, this is not the first time this has happened either. The 1950s were remarkably similar. This time around, it wasn't a demographic bust that caused it and the debts that came because of demographics. The last time around, it actually came from obviously World War II and those debts. But what did the governments do? In the US, they imposed yield curve control, which is financial repression, which is the same as adding things to the balance sheet. So they kept interest payments low. The economy, they restructured debts. The economy became perfectly cyclical, just as it is now. It's almost identical. And asset prices correlated entirely. So they ripped higher, corrected, every cycle, as they're doing now. So that whole 1950s thing actually plays out perfectly in the equity market. When I look at the chart of now versus the 1950s, it looks very similar. And when I zoom out, it kind of suggests what's going ahead. You see, in the 1950s, their piece of magic was to keep financial repression going, keep the cycle going until productivity increased. And eventually productivity increased, financial repression helped to wear down the debts, and over time the economy took off, and we had the 50s and the 60s and then into the 70s. And that was a magic period for GDP growth because of what they did, and they're repeating it now. It's very clear to me that that is the game.
Raoul Pal provides insights into the concept of the everything code and its implications for investors. He defines the everything code as the digitalization of all aspects of human life and economic activities through technology. This includes the rise of data, automation, artificial intelligence, and the Internet of Things, which collectively revolutionize industries, drive efficiencies, and open up new investment opportunities. Pal stresses the significance of grasping the everything code to navigate the ever-changing landscape of technology-driven markets. He highlights that companies embracing digital transformation and utilizing data analytics have a competitive advantage across various sectors. Furthermore, Pal recommends that investors consider exposure to companies leading the charge in the everything code to benefit from the ongoing digitization of the global economy. Apart from the everything code, Pal also delves into the liquidity cycle and its impact on financial markets. He defines liquidity as the availability of capital and its ease of deployment across different asset classes. Pal explains that liquidity cycles are influenced by central bank policies, investor sentiment, and macroeconomic factors, affecting asset valuations and market participants' risk appetite. Pal argues that comprehending the liquidity cycle is crucial for investors to navigate market volatility and spot investment opportunities. He points out that central bank liquidity injections, like quantitative easing programs, can inflate asset prices and fuel speculative behavior. Conversely, tightening liquidity conditions can trigger market corrections and asset repricing, presenting both risks and opportunities for investors.
Since I first started talking about Bitcoin, it's up 450,000%. Now, most people just still don't get why I care about this. It's because it's the only way I see to truly give yourself the opportunity. And this is, you can see this behavior of investing in risky things by the speculative economy that has taken hold that people can't understand. It makes total sense to me. If your future is fucked because you're young, you are going to do what you're supposed to do, buy your 401k, that kind of locks it in because it's not underperforming the balance sheet, it's not outperforming. So that's savings. Okay, I get that. And it's better than saving in cash. But everybody knows they can't get ahead. So people have become speculative. Speculative is okay if it's not at the casino. If it's in a secular trending market like crypto technology, go for it. Just do it in the right way. So we see the rise of not only tech investing on Robinhood, but option investing on tech in Robinhood. That's the way, the lottery ticket economy, where people just don't feel like they have a choice. There's no way for them to get the 100, 200, 300 grand that they need to get in the property ladder, or to feel like they've got the savings that they need. So people are taking bets, but in a secular market, actually pretty intelligent risk taking, and options are pretty intelligent too. Over time, if you get it right, you have the right tools, you learn how to invest. It's one of the core things that we do at Real Vision is try and teach people how to do this. You can make money. Crypto has been even easier because the sheer magnitude of the moves means you just buy and hold it. You just own the highest quality assets and do nothing. I mean, doing nothing is really that easy. Has been basically giving you about 100% a year returns for the last 7 years, 8 years. It's actually higher if you go back earlier in Bitcoin's time. But if you basically look at that, you're going to get somewhere between 80 and 200% returns, depending where you are on the cycle over time. So these are the compounded returns. These aren't just, year in, because obviously some years you're like 500% returns and other times you'll make down 70%. People don't get their heads around, but this is actually the best risk-adjusted reward asset of all time. Fidelity have this beautiful chart of all of these dot plots of risk-adjusted rewards of assets, and there's like, tech is quite high, and some markets are high, and then cyclical stuff like oil and stuff is low risk-adjusted returns over time because it doesn't really do anything. All of this, S&P, all in this. And then you go and there's a blank paper, and somewhere right at the top is a dot that says Bitcoin. It's a fucking alien. We have never been given an asset like crypto that has this risk reward by any yardstick. Drawdown versus, drawdown risk, volatility adjusted, any way you want to look at this asset, as long as it's over a period of time, it's by far and away the best asset we've ever been given. It's also the best performing asset of all time and remains the best performing asset. Every 4 years of that everything code cycle, Crypto Spring, which was last year, best performing asset in the world. Crypto Summer, this year, will be the best performing asset in the world. Crypto Fall, next year, will be the best performing asset in the world. Crypto Winter, which is 2026, will be the worst performing asset in the world. It's kind of simple. You don't need to do anything. You just need to buy it and hold it.
Raoul Pal discusses speculation and risk-taking in financial markets, shedding light on their significance and impact on investors. He recognizes speculation as a crucial element of market dynamics, involving the pursuit of profit by predicting future price movements. Pal acknowledges that speculation can drive market activity, leading to both innovation and volatility. However, he also emphasizes the difference between informed speculation, which is based on thorough research and analysis, and reckless gambling driven by emotions or herd mentality. Pal underscores the importance of managing risk when engaging in speculative endeavors within financial markets. He advises investors to thoroughly assess risk factors, taking into account both market-specific dynamics and broader macroeconomic trends. By diversifying their portfolios, implementing stop-loss orders, and adhering to disciplined investment strategies, investors can minimize downside risk and safeguard their capital during market fluctuations. Furthermore, Pal highlights the role of reflexivity in shaping market dynamics. Investor sentiment and market perceptions often influence asset prices and market outcomes. He cautions against relying too heavily on market narratives or extrapolating past performance to predict future trends, as this can lead to irrational optimism or unwarranted pessimism. Instead, Pal advocates for a balanced approach to speculation, grounded in fundamental analysis and a deep understanding of market psychology. Pal also discusses the significance of leverage and its implications for risk-taking in financial markets. While leverage can amplify returns, it also increases the potential for losses and exposes investors to market volatility. Pal advises against excessive leverage, urging investors to carefully assess their risk tolerance and financial capacity before utilizing leverage as a strategic tool. Raoul Pal's expertise provides a holistic grasp of investment prospects in technology, cryptocurrency, the everything code, and the liquidity cycle, shedding light on their game-changing potential and prospects for sustained growth. Pal's optimistic stance on cryptocurrency underscores its value as a safeguard against economic uncertainty and inflation, offering diversification advantages for investment portfolios. Furthermore, his examination of the everything code and the liquidity cycle delivers invaluable perspectives on maneuvering market dynamics and pinpointing strategic openings, underscoring the significance of prudent risk management and a profound comprehension of market psychology as fundamental principles for investors seeking to navigate financial markets with unwavering confidence and resilience. What investment strategies do you plan to implement based on Raoul Pal's insights? Share your thoughts in the comments below. If you found this analysis helpful, don't forget to subscribe to our channel for more updates on investment trends and market analysis. Give this video a thumbs up if you enjoyed it, and share it with others who might benefit from the information. Thanks for watching, and we'll see you in the next video.